The Liability Engine: How to Model a Points Currency. This is a manual disguised as an audiobook. Its subject is the single most important number a points company does not know: what its currency will eventually cost to honor. The commissioning question was narrow and practical. How should Amex, the Singapore Miles startup this series has been studying, model its miles liability? But the answer turned out to be broader than expected, because the loyalty industry has spent 40 years building exactly this machinery in public, in regulatory filings, and almost nobody outside the accounting departments has read it. American Express discloses the number to the basis point. Southwest names its predictor variables. United's auditor named the statistical technique. LATAM's auditor tests whether management is nudging members to redeem. All of it is public. None of it is assembled anywhere. So this study assembles it, and then it does the thing the assembly is for. It specifies the model, module by module, with the priors, the data schema, the cadence, and the governance. 3 findings frame everything that follows. First, the liability number most young programs carry rests on an assumption they have never validated against their own data, and the evidence suggests that assumption is too low, not too high. Second, a points liability is not one estimate but 2, and they are correlated: how many points get redeemed and what each one costs. Both move against the issuer precisely when the product succeeds. And third, the model is not a compliance artifact. It is a pricing tool, a valuation instrument, and a run-risk defense. The difference between building it before a devaluation and building it after is the difference between a company that prices its decisions and one that discovers them. Ground rules: everything quoted from a filing was extracted from that filing. Estimates are labeled. Analysis is labeled. And the last chapter says exactly what would prove this wrong. Let's begin. Chapter 1: The Unmodeled Promise. I want to start with the position exactly as it stands today, because every argument in this study is calibrated to it. Amex has issued, by its most recent public disclosure, roughly 272 million max miles cumulatively. Against that, 27 million miles have been redeemed. That is a cumulative redemption rate of about 10%. Outstanding balances are estimated at roughly 700 million miles by the middle of 2026, and the issuance run rate is above 500 million miles a year. So what does that outstanding pile cost? The working assumption in the independent dossier is a 75% ultimate redemption rate, at about 1.5 cents per redeemed mile. Run those 2 numbers across the book, and you get an expected future fulfillment cost of roughly $6.2 million US. 3 things about that figure are worth pausing on. It appears in no press release. It is 56% of all the capital the company has ever raised, and it is the highest scored risk in the company's own risk register. So the largest single obligation the business carries is a number the public has never seen, resting on an assumption nobody has tested against the company's own data. Now the uncomfortable part. This is the most important sentence in the chapter, so I will say it slowly. The 10% cumulative redemption rate is not evidence that redemption is low. Let me explain why, because the logic here is arithmetic rather than opinion. Take a program that is growing fast. Most of the miles sitting in member accounts today were issued recently, last month, last quarter, last year. Those miles have not had time to be redeemed. Redemption takes months, often years, because a member has to accumulate enough to buy something worth having. So when you divide every mile ever redeemed by every mile ever issued, you are dividing a numerator that reflects the old, mature part of the book by a denominator dominated by the young, immature part. A rapidly growing issuer will always show a flattering aggregate redemption rate. Always, it is not a signal about member behavior at all. It is a signal about the growth rate. The metric is arithmetically guaranteed to mislead, and it misleads in the direction of comfort, which is the worst direction for a metric to fail in, because nobody investigates good news. That is problem 1. Problem 2 is stacked directly on top of it. The 75% assumption is an airline-shaped prior, and Amex is not shaped like an airline. Where does airline breakage actually come from? Friction. There are no award seats on the flight you want. There are blackout dates. The award chart is opaque, or there is no chart at all. The redemption experience is a maze, and a large share of members simply give up somewhere inside it. Airline breakage is, to a first approximation, a measurement of how annoying the airline has made redemption. Amex has engineered that friction away deliberately as a product decision. Fly Anywhere pays for any flight on any airline at a fixed 1.8 cents a mile. It is always available. It requires no award inventory at all because it is not an award seat, it is cash against a ticket the member has already bought. Gift cards clear small balances at 100 miles to the dollar. And the member base is self-selected miles enthusiasts, people who arrived because they care about points, rather than the passive majority sitting in an airline's file who signed up once and forgot. Every single one of those features pushes the ultimate redemption rate up, not down, up toward the American Express end of the range rather than the airline end. We get to the American Express number in Chapter 5, and it is the most useful data point in this entire field. The analysis in this study puts a defensible band at 75 to 90%, with a central estimate around 82 to 85%. I want to label that clearly. That is analysis, not a finding. It is a reason band, not an observation drawn from Amex's own data, because Amex's own data has never been assembled in a form that could produce one. What does the gap cost? Moving from 75% to 85% is roughly $800,000 of additional liability on the current book. That is about 6% of every dollar the company has ever raised. And at the current scale, each single percentage point of ultimate redemption rate is worth roughly $60,000 a year of cost. 1 point, $60,000 a year. That is the sensitivity of this business to a number nobody has measured. And then there is a third structural fact, which does not merely add to the first two, it makes them worse. Because Fly Anywhere is universally available at 1.8 cents in hard cash, the marginal redemption cost is floored at 1.8 cents for every engaged member. Think about that from the member's side of the table. If 1.8 is always on the menu, no rational member accepts less. Any redemption worth less than 1.8 cents is only ever taken by someone who has not done the arithmetic, or who cannot yet reach the threshold. So where does the blended assumption of 1.5 cents come from? It survives on two populations: gift card takers and members who never redeem at all. And both of those populations shrink as a program matures and its members get more sophisticated. Which produces the finding that reframes the whole exercise. As the ultimate redemption rate rises, the cost per redeemed mile rises with it. The two terms of the liability are not independent variables, to be estimated separately and then multiplied together. They are the same phenomenon wearing two hats, and the phenomenon is product success. Modeling them as independent understates the tail badly. And the tail is the only part of a liability distribution that has ever killed anybody. So let me state the problem in one breath. A large, undisclosed, structurally understated obligation, measured by a metric that flatters by construction, resting on a prior imported from a different business with different physics, with two error terms that move together in the wrong direction precisely when things are going well. The rest of this study is about how the professionals solve exactly this problem and what Amex should copy from them. Chapter 2, the regime chain. Before the methods, some history. Because the loyalty industry has already run the experiment of pretending that a points liability is small, and the correction, when it came, was violent. For 37 years, U.S. airlines accounted for flight-earned miles at something called incremental cost. Here is American Airlines' own language, from its filings before 2018. The liability, they wrote, quote, is valued based on the estimated incremental cost of carrying one additional passenger. And that incremental cost, quote, primarily includes unit costs incurred for fuel, food, and insurance, as well as fees incurred when travel awards are redeemed on partner airlines. Now read what is not in that list. No aircraft, no crew, no gate, and no foregone fare, no allowance at all for the paying passenger who did not get that seat. The theory was that the plane was flying anyway, so the only true cost of an award passenger was the extra fuel to carry their weight, the meal in front of them, and the insurance. Under that theory, a mile cost roughly 1/7 of a cent, which meant that a program holding hundreds of billions of miles could sit on the balance sheet as a rounding error. The largest promise the company had ever made was, on paper, one of its smaller numbers. Then the accounting changed. International standards moved first. A rule known as IFRIC 13 forced fair value deferral onto international reporters from 2008. American accounting followed in 2018 with the revenue standard, a SC 606, which killed the incremental cost option outright. Under the new regime, a mile is not a cost at all. It is a separate performance obligation. That phrase is worth unpacking because it is the hinge of the whole thing. When a passenger buys a ticket and earns miles, the airline has sold two things: a flight now and a promise later. The revenue has to be split between them, and the miles portion is deferred until the miles are actually used. The miles are measured at what accountants call the standalone selling price and what airlines call equivalent ticket value. Roughly, what the mile actually buys. So what was that reclassification worth? The transition table tells you, and it is one of the most striking numbers in corporate accounting. American Airlines total stockholders' equity, restated, $3.9 billion as reported, negative $780 million as recast. The flight-earned mileage liability moved from a $677 million incremental cost stub to a multi-billion-dollar deferral. One accounting change, and the company's entire book equity vanished. Not a single flight changed. Not a dollar of cash moved. The promises were exactly the same promises they had always been, only the measurement was different. That is the clearest demonstration available anywhere of the gap between what a points promise costs to make and what it costs to keep. And it is precisely why this study exists, because Amex is a young company whose cash accounts and accrual accounts already disagree by a wide margin. The dossier's estimate for fiscal 2026 is earnings before interest, taxes, depreciation and amortization of plus $2.6 million on a cash basis, against minus $1.2 million on an accrual basis. That is a gap of $3.8 million, 27% of revenue. That is not an accounting curiosity. It is the difference between the company the bank statement describes and the company the audited accounts will describe. And the second one is the company a Series B investor diligences. 3 features of the modern regime matter for anyone building a model inside it. Let me take them in order. 1. Breakage is recognized proportionally, never as a lump. The language is nearly identical across American, Delta, and United. Breakage is recognized, quote, proportionally as the remaining miles are redeemed. In plain terms, you do not book a gain on the day points expire. You take your estimate of how many will never be redeemed, and you drip that estimate into revenue as the other points get used. There is a consequence here that a startup should sit with for a while. An over-optimistic breakage assumption pulls revenue forward into today's profit and loss, which means a young company under pressure to show revenue has a structural incentive to assume high breakage. And high breakage is precisely the assumption that later reverses as a charge. 2. Those reversals are real, and they are large. 3 examples from the record. Hawaiian adopted a 20% breakage assumption in 2007, and it produced a $5 million one-time benefit to operating income. American later reduced its breakage estimate, and that produced a $43 million revenue charge. And the cleanest recent example. Southwest booked a $116 million breakage reversal in the fourth quarter of 2024, after abolishing expiry destroyed the data its model relied on. breakage assumptions are earnings levers, and earnings levers reverse. 3, and this is the one that lands hardest on a company like Amex. Killing expiry destroys the evidence. Delta's auditor states it plainly in the audit report. There is, quote, complexity and subjectivity in estimating mileage breakage due to the absence of historical expirations as the company's mileage credits do not expire. Think about what that sentence is admitting. A program that promises its miles never expire has removed the only clean observation of non-redemption it would ever get. If miles expire, then one day the system tells you, precisely and finally, how many were never used. You get a settlement. You get a fact. If they never expire, that day never arrives. You are left estimating forever, with nothing to check yourself against. Amex markets exactly that promise, never expire, while its own terms reserve a 12-month inactivity forfeiture. The dossier already flags that contradiction as the largest untreated reputational risk in the business. What this study adds is that it is also a modeling problem, and a serious one. The model must state, explicitly and in writing, whether the forfeiture is enforced, because an auditor will ask, and the marketing has already answered. Chapter 3, the Airline Method. This is the reconstruction the study was built to produce, how a major carrier actually computes its loyalty liability. Nobody publishes the recipe in one place. I assembled it from disclosures across American, Delta, United, Southwest, Alaska, and LATAM. It runs in 5 phases, and I will call them a through. Phase A, set the unit value. The engine of the entire calculation is equivalent ticket value, and Delta names it directly. Miles are valued at, quote, the quantitative value a passenger receives by redeeming miles for a ticket rather than paying cash. That sounds simple. The discipline is in which fares you benchmark against. United is precise about it. They use, quote, the prior 12 months weighted average equivalent ticket value of similar fares as those used to settle award redemptions. Read that carefully, not the retail fare of some arbitrary seat. The fare of the seat's members actually redeem into over the trailing 12 months. If your members redeem into cheap off-peak economy, then that is your benchmark, whatever the brochure price of a first-class ticket happens to say. Then it gets cut. United weights its value by, quote, redemption pattern, cabin class, loyalty status, and geographic region. American cuts by, quote, geographic region and class of service. And notice what nobody does. Nobody computes a single blended cents per mile number first and then applies it everywhere. The blended number falls out of the mix as an output. It is a result, never an input. Furthermore, wherever an observable price exists, it replaces the estimate entirely. Alaska uses, quote, actual consideration received from the partners for partner-earned miles. If a bank paid you a real price for a mile, that price is the answer. Stop modeling. Phase B, estimate breakage at the account level. This is the part most people get wrong because they assume breakage is a portfolio average. It is not. United, again, quote, the likelihood that an account will redeem its miles can be estimated based on a consideration of the account's historical behavior. And they build, quote, a statistical model to estimate the probability that an account will redeem its current miles balance. Account by account, not program-wide. Southwest is the only carrier that names its predictor variables, and they are worth memorizing. Quote, tenure with the program, points accrued in the program, and points redeemed in the program, which Southwest describes as, quote, typically representative of a member's level of engagement. Alaska adds 3 more, quote, source of mileage credit earned, slow-moving, and low-credit accounts. If you have ever done survival analysis, you recognize that list instantly. Recency, frequency, balance, acquisition channel, those are classic survival model covariates. The airlines are running actuarial machinery and describing it in plain English. The technique itself was disclosed exactly once in the entire record, and it was disclosed by an auditor, not by a company. United's 2019 audit report, quote, breakage is estimated annually using prior year's data and a regression analysis to estimate future breakage. LATAM's auditor adds that its statistical models are built, quote, with the assistance of an external specialist. And then the caveat that matters most for a company like Amex, again from United's auditor. Breakage, quote, can be impacted by changes in customer behavior driven by program changes or redemption opportunities that would not be reflected in historical redemption data. Translate that into operating language. A new transfer partner, a promotion, or a devaluation breaks the fitted curve. Your history stops predicting at exactly the moment management acts, which means the model has to be rerun around management actions, not once a year in the quiet. Phase C, allocate the money. For flight earned miles, this is a relative standalone selling price split. The ticket price gets divided between the flight and the miles in proportion to what each is independently worth. The co-brand contracts are harder and much more interesting. When an airline signs a credit card deal with a bank, that contract is not one thing. You have to identify every separate performance obligation inside it. United names 4. Delta names 5, American names 2, then you price the non-mile pieces with a discounted cash flow. Delta's list of inputs is worth going through because it shows you what the bank is actually buying. Expected miles awarded and redeemed, equivalent ticket value, adjusted for breakage, published rates for baggage fees and lounge access, quote, brand value using estimated royalties generated from the use of our brand, and volume discounts. American goes further and says the quiet part out loud. The marketing component, the brand and the member lists, is, quote, the predominant element in these agreements. The bank is buying the brand more than it is buying the miles. And here is the mechanical detail with the biggest strategic consequence. The allocation percentages are struck at contract inception for the whole term. They do not float afterwards, which is why every co-brand renegotiation is an accounting event, not merely a commercial one. Phase D, carry and release. Delta again, quote, miles are combined in one homogeneous pool and are not separately identifiable. One pool, no individual mile has a name on it. Revenue releases as miles are redeemed and travel is provided. Breakage drips in proportionally, as we covered in the last chapter. And the split between current and non-current liability, that is, what the company expects to pay out within 12 months versus later, is itself a model output based on projected redemption timing. Which is exactly why it varies so widely between carriers. Roughly 60% current at Southwest, about 35% at American. Same industry, same accounting standard, wildly different member behavior. And when an assumption changes, it reprices the entire remaining pool at once. Not gradually, not going forward, all of it immediately. That is what a $116 million catch-up looks like from the inside. Phase E, get it audited, which is the next chapter. So here is the one-line version. If you remember nothing else from this chapter, remember this. Value the mile at what the seat's members actually redeem into are worth. Predict, at the account level, how many will never be redeemed. Split the bank's check between miles and brand using a discounted cash flow struck at signing. Then release the deferred pile, breakage included, one redemption at a time. 4 moving parts, 40 years of refinement, and all of it sitting in public filings that almost nobody reads. Chapter 4, what the auditors test. The most useful documents in this entire literature are not the company filings. They are the audit reports. And the reason comes down to a disclosure requirement that most people outside the profession have never heard of, called the Critical Audit Matter. Let me explain what that is, because it unlocks the whole chapter. When an audit firm signs off on a large public company's accounts, it is required to describe the matters that involved especially challenging, subjective, or complex judgment. In practice, a critical audit matter is an auditor publicly declaring which of management's estimates frighten them most. It is about as close to a confession as corporate reporting ever gets, and it comes attached to a description of exactly what the auditor did about it. Now, the headline finding from the record. In fiscal 2019, loyalty was a critical audit matter at all 3 U.S. majors: American, Delta, and United. Today it is a critical audit matter at none of them. Delta's mileage breakage matter ran from 2019 through 2024, and then vanished in the 2025 audit, where the only critical matter is a pension valuation. Read that trend carefully because it is easy to read backwards. It does not mean the estimate got small. Delta's mileage liability is enormous and it is growing. It means the estimate got routine. The models matured. The backtesting accumulated. Year after year, management's projections landed close enough to actual outcomes that the auditors eventually stopped flagging them. That is the destination. That is what a mature loyalty liability model looks like from the outside: silence. But what the auditors do while it is still a matter, that is the instruction manual. If you want to know what a good model has to survive, read what the people paid to attack it actually do. Take a composite across the Ernst & Young, KPMG, and PricewaterhouseCoopers reports, and they test 6 things. 1. Controls over management's review of the estimate. 2. The completeness and accuracy of the underlying mileage data coming out of the IT systems. 3. Recomputation of the model's key calculations. 4. Independent development of a rival estimate. 5. Benchmarking against program changes and industry conditions. And 6. Retrospective review of prior estimates against actuals. I want to draw out 3 of those because they are more aggressive than most people expect. First, the auditors bring their own actuary and build a competing model. Ernst & Young at Delta, describing their own procedures. Quote, involving an actuarial specialist to independently develop a range of mileage breakage estimates and compare to the company's estimate. Sit with the implication of that. Your model is not being reviewed, it is being raced. Someone with actuarial training builds their own version from your data and then checks whether your answer lands inside their range. If your number is a judgment call with a paragraph of justification attached, that race is not going to be close. Second, the auditors benchmark you against your competitors. KPMG at American. Quote, we compared the company's estimate of mileage credits not expected to be redeemed to that of other airlines within the industry. So your breakage assumption is not evaluated only on its internal logic. It is evaluated against the peer set. If everyone in your industry assumes a redemption rate inside one band, and you have picked a number outside it, you will be asked to justify the difference, with structural reasons, not with preference. Which is precisely why this study spends so much time on comparables and priors, and why the next chapter matters as much as it does. Third, and this is the one I would put on the wall, the auditors watch whether management is manipulating the number through product decisions. PricewaterhouseCoopers at LATAM assessed the company's assumptions against, quote, management's actions to incentive holders of the loyalty programs to redeem their miles. Think about what that procedure is designed to catch. Breakage is an estimate of how many points will never be used, but management controls how easy it is to use them, so management can move its own estimate simply by moving the product. Run a promotion and redemption rises, make redemption harder and breakage rises. The auditor is checking whether the estimate and the product strategy are telling the same story about the same members. Now put that in the Amex context because it is uncomfortably direct. A company that runs a 20% transfer bonus into a channel and then cuts that channel's rate 3 months later has taken exactly the kind of action an auditor is trained to look for. I am not alleging anything at all about intent. I am pointing out that the sequence is legible from the outside, and that the profession has a named procedure for reading it. One more finding from the audit record, and it is the sharpest argument in this entire study for building the model early rather than late. Delta's auditor states that estimating breakage is hard, quote, due to the absence of historical expirations, as the company's mileage credits do not expire. Turn that over slowly. What it means is that the programs with the most generous promises have the least evidence about their own liabilities. Generosity and uncertainty are the same decision, taken once. Every program that removes expiry buys goodwill with one hand and destroys its own measuring instrument with the other. There is no version of never expires that also gives you clean data on non-redemption. You get one or the other. Amex markets never expire. It therefore inherits the hardest version of the estimation problem on the shortest history with no actuary in the building. That is not an argument against the promise. It is an argument that the promise raises the bar on the modeling, and the modeling has not yet been built to meet it. Which brings us to the question the auditors themselves would ask next. If you cannot observe your own breakage, what do you anchor your estimate to? The answer is other people's disclosures, and the best one in the world belongs to a bank. Chapter 5, The Bank Standard. If the airlines supply the method, American Express supplies the benchmark. And I want to be emphatic about this one. The American Express annual report is the single most useful public document in this entire field. If you read one primary source, read that one. Here is the sentence, verbatim, from the fiscal 2025 annual report, filed in February 2026. Quote, "The membership rewards ultimate redemption rate for current program participants was 96%, rounded down, at both the 31st of December 2025 and 2024. 96%, and the liability sitting behind that rate is $16.5 billion. For scale, that is roughly 2,600 times the entire estimated liability of Amex. Let me take the disclosure apart, because every clause in it teaches something. First, how they estimate it. Quote, "We use statistical and actuarial models to estimate the ultimate redemption rate of points earned to date by current card members based on redemption trends, card product type, enrollment tenure, card spend levels, and credit attributes. Count the inputs, redemption trends, card product type, enrollment tenure, card spend levels, credit attributes. 4 of those 5 are segmentation variables, which tells you something important about how serious issuers work. The world's largest points issuer does not compute one blended rate for its entire book. It computes many rates for many slices of members and then aggregates them. A platinum cardholder of 15 years standing and a brand new no-fee cardholder are not the same statistical animal, and American Express does not pretend otherwise. Second, the cost side is measured, not assumed. Quote, "The weighted average cost per point assumption is derived from 12 months of redemptions." That is a discipline worth stating as a rule. You do not guess what a point costs you. You observe what your last 12 months of actual redemptions actually cost, in cash, and you use that. The cost per point is a measurement, not a judgment. Third, and this is what makes American Express the model to copy rather than merely the benchmark to cite, the two-way sensitivity. Amex publishes what happens to its liability if each of its 2 key assumptions moves. An increase in the ultimate redemption rate of 25 basis points, that is 1/4 of 1 percentage point, would increase the liability and the rewards expense by approximately $229 million. And an increase of 1 basis point in the weighted average cost per point, 1 basis point being 1/100th of 1 percentage point, would increase it by approximately $244 million. 2 assumptions, 2 derivatives, both published voluntarily in a public filing. That is what a company that genuinely understands its own model looks like from the outside. It can tell you not only what its answer is, but how fast that answer moves when the world shifts underneath it. And now the historical artifact that proves the stakes here are real rather than theoretical. In the 4th quarter of 2012, American Express moved its global ultimate redemption rate from 93% to 94%, 1 percentage point, and it booked a $342 million charge in a single quarter. 1 point on 1 assumption, $342 million of earnings gone in 3 months. That is the entire argument for taking this number seriously, compressed into a single line item. 2 more observations from the banking record, because none of this is an American Express peculiarity. JP Morgan Chase carries a $16 billion card rewards liability, up from $14.4 billion. And the stated reason it moved is exactly the mechanism we have been circling all along. Points earned, quote, outpaced redemptions all year. Chase also discloses a combined sensitivity of $512 million. Capital One carries an $11.1 billion rewards reserve against $11.5 billion of annual rewards expense, so the reserve is roughly the size of 1 year's rewards spending. And Citigroup discloses no separate figure at all, which is a useful reminder that disclosure is a choice. The number exists at Citigroup too. They have simply decided not to show it to you. Now the observation that matters most, and it is strategic rather than accounting. The American Express number is 96%. Think about what kind of currency produces 96%. A transferable points currency, with no expiry, with an always available cash equivalent redemption option, held by engaged, self-selected, fee-paying members. Under those conditions, ultimate redemption is essentially total. Breakage of 4 points and, on the trend, shrinking. Now read that description again and ask which of those features Amex does not have. Transferable currency? Yes. No expiry, at least as marketed? Yes. Always available cash equivalent redemption? That is fly anywhere at 1.8 cents in hard cash. Engaged, self-selected members? That is the entire member base by construction. Every structural feature in the American Express description is a feature Amex also has. That is the strongest single piece of evidence in this study that a 75% prior sits at the wrong end of the range. Let me be careful about what I am and am not claiming, though. I am not saying Amex will land at 96. American Express has decades of tenure, fee-paying cardholders, and a very different mix of redemption options. That is analysis, not a finding. What I am saying is that the ceiling case for a currency shaped like this one is essentially full redemption, and a prior should be set with reference to where the ceiling is, not in ignorance of it. 75% was borrowed from an industry whose breakage comes from friction that Amex has deliberately removed. The 96% is a finding. It is quoted, word for word, from a filing. The inference that Amex belongs nearer that end of the range than the airline end is analysis. It is falsifiable, and the final chapter of this study says precisely how you would falsify it. That is the benchmark. Now we go to the evidence from outside the points industry entirely. Chapter 6: Gift Cards and the Legal Perimeter. 2 more bodies of evidence complete the professional picture. The first is a laboratory that has been running in public, at scale, in plain sight, and almost nobody in loyalty bothers to look at it. The second is where a points issuer based in Singapore should pay the closest attention of all, because it is the point where an accounting question quietly turns into a licensing question. Start with the laboratory, gift cards. Starbucks is the cleanest public example of the proportional breakage method operating at genuine scale. In fiscal 2025, the company recognized $222.4 million of stored value breakage revenue. Behind that number sits a stored value and loyalty deferred revenue balance of $1.75 billion. So this is not a curiosity buried in the footnotes. It is more than $200 million a year of revenue that exists only because some customers never spend what they loaded. The recognition language is the modern revenue standard in the wild. Breakage is amortized in proportion to stored value card redemptions. That is the same proportional drip the airlines use for miles. You do not book a gain when the money goes stale, you release it as the other balances get spent. Redemption rates are estimated market by market, and the segmentation axes are vintage and load channel. When the value was loaded, and how it arrived. And the whole figure is struck net of amounts remitted to state governments under escheat law. the unclaimed property rules that require abandoned balances to be handed over rather than quietly kept. 2 lessons transfer directly to a points issuer. The first is about segmentation. Vintage and load channel are the axes a real operator actually uses. Not age, not income, not customer demographics. When the value entered the system, and through which door. That is precisely the cohort by earn channel structure this study will specify later. The largest stored value operator in the world segments on the 2 variables that a points company already has sitting in its database and mostly ignores. The second lesson is a warning against the wrong analogy. Work out the implied breakage rate at Starbucks, and it is only around 1.5% of annual loaded value. That is far below the numbers people casually quote for gift cards, and the reason is structural. Reloadable wallets break far less than single-load gift cards. A card bought once as a present, half spent, and left in a drawer is a completely different instrument from a balance that keeps receiving new deposits month after month. A points balance is the second kind. It is a reloadable wallet, not a gift card. So anyone reasoning about a points program's breakage from retail gift card intuitions is reasoning from the wrong instrument entirely. Now the legal perimeter, and here is the unifying frame this research produced. It is the most strategically useful sentence in the chapter. Escheatment law and electronic money regulation ask the same 2 questions. Did the customer pay money for this? And can they get money back? Answer no to both, and you sit outside both regimes. Answer yes to either one, and both start circling. The specifics matter, and in Singapore they matter enormously. The Payment Services Act contains an exemption for what it calls limited purpose electronic money, and the definition reads almost like a design specification for a loyalty currency. The dominant purpose must be promotional. It must be issued in connection with a purchase. It must be spendable at specified merchants, and, critically, it cannot be withdrawn in exchange for currency. That last clause is the load-bearing one. Everything else in the exemption describes how the value is created. That clause describes how it leaves. Cross it, and the character of the instrument changes. What lies on the other side of that line is not a fine. It is a licensing regime with real economics attached. Above 5 million Singapore dollars of average daily float, an electronic money issuer becomes a major payment institution, and it must safeguard 100% of the float from the moment of receipt. Read that consequence carefully, because it destroys 2 things at once. It destroys the float income, because the money can no longer be put to work. And it destroys the breakage argument, because money you are required to hold in trust for a customer is not money you get to recognize as revenue when the customer fails to spend it. Japan runs the same idea at a different dial setting. A 50% deposit with the Legal Affairs Bureau once unused balances exceed 10 million yen, half rather than all, at a far lower threshold, which is proof, incidentally, that safeguarding thresholds are a policy dial, not physics. They can be moved, and in some jurisdictions they already sit somewhere else. The American comparison completes the picture, and it is the clearest single illustration of why those 2 questions are the right 2 questions. United States law explicitly protects gift card holders. There is a 5-year minimum life under Regulation E and a 1-year inactivity floor before dormancy fees may be charged. And that same body of law explicitly exempts loyalty points from both protections. Points sit outside consumer protection precisely because nobody paid cash for them. Which brings the perimeter home to the company this study was commissioned for. Fly Anywhere reimburses a member's flight purchase in cash by bank transfer through PayNow. Amex first takes cash in advance against currency to be delivered later. Every widening of acceptance, every additional way to turn miles into something that behaves like money, pushes in the same direction, toward a yes on at least one of the 2 questions. None of this is a violation today. The independent dossier's assessment is that the posture is defensible, but that the trajectory is toward the boundary rather than away from it, and that assessment stands. The modeling consequence, though, is concrete, and it belongs inside the liability model as an explicit scenario rather than a footnote in a legal memo. If the currency were ever reclassified, two things happen simultaneously. The float stops being an asset and becomes a safeguarding obligation, and the breakage assumption stops being available at all. That is a scenario in which the liability does not merely get larger. It changes species. A model that cannot price that scenario is a model that has quietly assumed the perimeter holds forever. Chapter 7 runs on a points bank. Here is a gap in the literature worth naming out loud. There is no academic work applying bank run theory to loyalty currencies. None. The framing in this chapter was built from scratch for this study because the analogy is exact and the industry has somehow never formalized it. A bank makes a promise. It will convert deposits into cash on demand while holding assets that cannot be turned into cash on demand. That mismatch is the entire business, and it is also the entire vulnerability. A points issuer makes a structurally identical promise. It will convert points into travel on demand. And in Amex's case, through Fly Anywhere, it will convert points into actual cash on demand. Against that promise, it holds no reserve at all. Not a small reserve. None. The classic result about this arrangement is that it has two equilibria. In the good one, nobody runs because nobody expects anybody else to run, and the promise gets honored comfortably out of ordinary flow. In the bad one, the expectation of a run is what causes the run. Each holder redeems not because they wanted to redeem today, but because they believe others will get there first. Nothing about the underlying business needs to change to move from one equilibrium to the other. What tips it is a coordinating signal. Now the asymmetry that makes points worse than deposits, and it is the sentence to carry out of this chapter. A bank run is triggered by fear of the bank's insolvency. That is a question of fact, and a solvent bank can in principle rebut it with a balance sheet. A points run is triggered by fear of the issuer's discretion. It is the entirely rational expectation that the issuer will unilaterally reprice the currency. And every set of loyalty terms and conditions in the world explicitly reserves the right to do exactly that, which means the panic trigger is written into the contract. The member who redeems early is not being paranoid. The member is reading. There is a second asymmetry, and it concerns the safety net. A bank has deposit insurance, a lender of last resort, a capital requirement, and a supervisor. A points issuer has none of the four, and the industry has already run that experiment in the field. When Midway Airlines collapsed in 1991, rival carriers honored its tickets and refused its miles. A ticket was a service another airline could actually deliver and get paid for. A mile was somebody else's promise. That is the definitive demonstration that there is no rescue facility for balances. Then there is the coordinating layer, which is the part most operators underestimate badly. In banking, the coordinating signal is physical and famous. It is a cue outside a branch. Everyone can see it, and everyone draws the same conclusion at the same moment. In loyalty, the coordinating layer is a telegram channel, a blog post, and above all a date. When a program publishes an effective date for a devaluation, it hands every member two things at once. A free option, because redeeming at the old rate before the deadline is strictly better than redeeming after. And a shared deadline, which means every holder of a balance receives the same instruction and the same clock in the same week. The record bears this out cleanly. United's 3-month notice in late 2013 produced a documented pre-deadline booking rush. Alaska's overnight, no-notice repricing in 2016 produced no run at all because there was no window in which to run. Which yields an uncomfortable conclusion, stated plainly. No notice is the only devaluation that fully prevents a run. The bill does still arrive. It arrives later, and it is denominated in trust rather than in cash. That sets up the stress test this study proposes, and it is the simplest useful number in the entire model. Take the outstanding balance. Multiply it by the floor conversion rate, meaning the best rate any member can get on demand without asking permission. Divide by unrestricted cash. That is the whole calculation. Outstanding balance times floor rate divided by cash. Above 1, you are a bank without reserves. For Amex, on the dossier's own figures, it works out like this. Roughly 700 million miles outstanding. At the Fly Anywhere floor of 1.8 cents, that is about $9.6 million of gross claim, against roughly $9.5 million of cash, a ratio of about 1.0. Every input there is approximate, and the output is an estimate rather than a finding. The order of magnitude is the point, not the third decimal place. And notice what that comparison actually reveals, because it reframes the whole of Part 1. The modeled liability of about $6.2 million is the expected view. It is what the book costs if members behave the way the assumptions say they will, spread over the years the assumptions say it will take. 1.8 cents on every outstanding mile is the stress view. It is what the book costs if every engaged member takes the best available exit at once. The gap between those two numbers is the run exposure. And at present, that gap is approximately the size of the entire balance sheet. None of which means a run is likely. Programs sit at ratios like this for years without incident because the coordinating signal never arrives and ordinary redemption stays ordinary. The claim here is narrower and much harder to argue with. A ratio of about 1 is not a crisis. A ratio of about 1 that nobody computes, nobody reports, and nobody watches is a different thing entirely, because there is no threshold at which anybody has agreed to act. The number should be on a dashboard. Today it is not on one. Chapter 8, the Casebook. 20 cases were assembled in the research for this study. Programs that died, programs that were rescued, programs that quietly defaulted without ever using the word. What follows are the patterns that matter, because they resolve into rules rather than anecdotes. Rule 1. Balances survive Chapter 11 and die in liquidation. In a reorganization, the loyalty program is the crown jewel. It is the asset that makes the airline financeable, the thing lenders will actually take security against, and destroying it would destroy the very collateral that funds the restructuring. So the miles get honored. In a liquidation, there is no future to protect, and miles become general unsecured claims sitting at the bottom of the waterfall, behind everybody. Spirit is the recent definitive case. 2 trips through Chapter 11, then operations ceased in May of 2026, and free Spirit points became unsecured claims to be determined later through the bankruptcy court process, with expected recovery near zero. Midway in 1991 wiped out roughly 700,000 members, and Ansett's collapse destroyed 8.8 billion points across more than 2 million members. That Ansett case carries one detail that should be read aloud in every loyalty boardroom. Only 17% of members had ever considered bankruptcy a risk to their balance. 17%. Members do not price insolvency into a currency they have been told will never expire. The promise of permanence does not merely reassure them. It removes the question from their minds entirely. Rule 2. Separate, capitalized entities survive their airlines. When Jet Airways stopped flying in 2019, its program was held in a separate entity with an outside shareholder, and roughly 10 million members' miles were preserved in full. The airline stopped. The currency did not. When Virgin Australia entered administration in April of 2020, Velocity was likewise held in a separate solvent entity. What happened next is the most instructive 4 weeks in the history of this industry. Velocity suspended all redemptions for about a month while members ran on hard goods. Then it resumed, and the points were honored in full under new ownership. That freeze is the loyalty industry's only clean proof that suspending convertibility works exactly as the theory from the previous chapter predicts. It stops the run, it buys time, and it costs nothing permanent. But that last part carries a condition that cannot be skipped. It works provided the entity behind the freeze is actually solvent. A suspension by an insolvent issuer is not a circuit breaker. It is the beginning of the end. Rule 3. The same product category produces opposite ethics depending on whether a solvent parent stands behind the liability. Cash Rewards announced its wind down at noon on a Tuesday in September of 2025. It then kept tracking purchases for 3 more days, approved everything pending by that Friday, and paid its members out in full. An orderly close, with the cash actually leaving the building. Drop did something else. Drop simply let its gift cards be perpetually sold out. No filing, no notice, no announcement, no wind down. Just a redemption catalog that never had anything in it. That is a redemption default achieved without ever declaring one, and it gives us a rule with teeth. A program can default without filing anything. Out of stock is a devaluation to 0. Rule 4, your widest spread is where the run happens. Which brings us to the case in the mirror, and it is the reason the previous chapter is not a theoretical exercise. Amex added a core in September of 2024. It restored the rate in October of 2025. It ran a 20% transfer bonus into that channel in March of 2026, and then it cut the ratio by 33%, announced on June the 22nd, effective July the 1st. 8 days of notice. The cut cascaded into the U conversion rates as well. The Mile Lion read the sequence correctly in public, writing that Amex must have been seeing a surge in core redemptions at volumes that were unsustainable, and is now attempting to meter the flow by devaluing the transfer ratio. The sequence is the lesson, and it generalizes far beyond this one program. The promotion trained members onto the exact channel that later had to be throttled. A transfer bonus is not a neutral marketing spend. It is an instruction telling members where the best value sits, and members who take that instruction do not forget it 3 months later. There is a second layer to the sequence. The Accor cut followed the withdrawal of cash for miles by 5 weeks. That withdrawal removed 17 partners on 14 days of notice. So an outflow channel was closed, and the outflow did not disappear. It moved, which gives the general form of the rule. Withdrawing one convertibility channel pushes the run onto the next one. Both of those moves were perimeter defenses. The core floor at 1.8 cents survived both, and that is what held the credibility of the currency together while the edges were being trimmed. And there is an encouraging reading of all this, which is easy to miss under the criticism. Amex now has something almost no program on earth has. A real, observed, internal run event on its own book, with its own members, its own channels, its own dates, and its own volumes. Most issuers modeling redemption surges have to borrow a scenario from someone else's history and hope the shape transfers. This one does not have to borrow anything. It can calibrate a stress model against an event that actually happened to it. That is worth more than any benchmark in this study. Chapter 9. Devaluation as Liability Management. Now the uncomfortable mechanic that connects the methods in Part 2 to the stress in Part 3. A devaluation is a liability management instrument. Cutting what a point buys reduces what the issuer owes. That is not cynicism, and it is not an accusation. It is arithmetic, and it deserves to be stated plainly in exactly those words because a mechanic nobody names is a mechanic nobody governs. Stated openly, it becomes a lever with a price attached. Left unstated, it becomes something a company improvises under pressure and then explains afterwards. The research turned up exactly one clean, quantified, public example of the arithmetic running end-to-end. And it runs in reverse, which makes it more instructive rather than less. Air Miles in Canada announced a 5-year expiry policy in 2011 to take effect at the end of 2016. Then, weeks before it actually took effect, under regulatory and public pressure, the company canceled it. The reversal cut its breakage assumption from 26% to 20% and produced a $242 million revenue charge. Sit with the proportions there. 6 points of breakage, roughly $250 million, one policy reversal, and not a single point was actually redeemed on the day the charge was booked. The expiry policy had been quietly financing the income statement for 5 years, and canceling it sent the whole accumulated benefit back where it came from. That is the only such disclosure in the record, and the absence of any comparable disclosure elsewhere is itself one of the findings of this study. No United States airline has ever disclosed a devaluation's profit and loss effect as such, not because the effects were small, but because dynamic pricing made repricing continuous and therefore invisible. If the price of an award changes a little bit every day, there is no event to disclose, no before and after, no single date on which the liability was restruck. Delta deleted its award charts in 2015 and has repriced silently ever since. No published chart, no deadline, no run. And, as the nickname the enthusiast community uses for its currency attests, a decade of permanent distrust. That is the trade, stated honestly. Removing the peg eliminates run risk and buys distrust instead. You can have the deadline and the rush, or you can have the silence and the reputation. There is no configuration that gives you neither. For a company in Amex position, 3 governance conclusions follow, and each of them is a concrete change to how decisions get made. First, the model must run before the announcement, not after. This inverts the current order of operations, and it is the single highest value change in this study. A liability model that runs before a pricing decision is a pricing tool. The same model, run afterwards, is a reporting tool. The first is worth an order of magnitude more than the second, because it is the difference between choosing the size of a devaluation and discovering its consequences. And discovery is the right word for what the public record shows. The cascade of the Accor cut into partner conversion rates appears, from the outside, to have been discovered rather than modeled. A pre-announcement model run would have surfaced that cascade as an output rather than as a surprise. Second, the notice window has a price, and it should be a line item. A published effective date guarantees a pre-deadline surge at the old rate. That is not a risk, it is a certainty, and the previous chapter showed the mechanism. But a certainty is exactly the kind of thing a model handles well. The surge is forecastable from cohort behavior, its cash cost is estimable, and it should be provisioned before the announcement goes out, not absorbed in surprise afterwards. 8 days of notice sits below every peer norm on the record. The major banks work to conventions of 30 to 90 days, and the correct response to that gap is not to shorten notice further in order to suppress the surge. It is to model the surge and fund it. Shortening notice is a way of buying cash with trust, and the exchange rate on that trade is terrible. Third, rank the levers before pulling one. There is a trust cost ladder here, and it runs from cheap to catastrophic. Tightening a promotion, adjusting a single partner ratio, withdrawing a peripheral channel, cutting a headline rate, and finally, the irreversible one, cutting the floor itself. The 1.8 cent fly-anywhere floor is the credibility of the entire currency. It is the reason a member believes a mile is worth something regardless of what any individual partner does. Every peripheral defense that leaves the floor intact is cheap by comparison with touching it, and the ordering matters more than any single decision. The governance checklist should force one question before an expensive lever is pulled. Is there any cheaper lever remaining that has not been used? And there is a limit on how many times even the cheap levers can be pulled. 3 value cuts in 12 months is, in the dossier's own assessment, the outer edge of what a program can absorb. A 4th would not merely spend trust. As the previous study in this series established, it would disarm the acquisition machine itself, because that machine runs on being the visible exception to program unilateralism. A program that markets itself as the one that does not do this to you cannot do this to you 4 times a year. Which is the real reason a devaluation deserves a model rather than a memo. The cash saving is calculable in advance. The trust cost is not. So the only responsible way to run the trade is to know the first number exactly before you spend the second one blind. Chapter 10, the Toolkit Triangles. Now the payoff. 6 methods in the order a program should adopt them. The first 3 are mandatory. The last 3 are the maturity ladder. This chapter covers the foundation, and the foundation is a shape. Start with the analogy, because it is the unlock and it is exact. A general insurer sells a policy in 1 month and does not learn what that policy cost for years. Claims arrive late and settle slowly, some still open long after the premium has been spent. So the insurer must state today what it will eventually owe on business it cannot yet observe. Actuaries solved that problem decades ago with 2 tools: the loss development triangle and the chain ladder method. A points issuer has structurally the identical problem. Issue a mile today, learn its cost years later. The only actuarial firm in the world focused solely on loyalty programs frames its whole business on this sentence. Loyalty programs issue points today, but won't know the actual cost of those points for years. That is an insurance problem wearing a marketing costume, and the insurance answer applies unchanged. So, how to build the triangle? Once you can see the shape, most of the confusion in this field disappears. The rows are issuance cohorts, 1 per month. The January 2025 row means all the miles earned in January of 2025, and those miles stay in that row forever, no matter when they are eventually spent. The columns are development lag, not calendar time. Age. Column 1 is 1 month after issuance, column 2 is 2 months, and so on. Each cell holds one number, the cumulative percentage of that cohort's miles redeemed by that age. Now picture the grid filled in. Your oldest cohort has been alive longest, so its row runs furthest to the right. Each newer cohort has 1 fewer column filled, and the newest has exactly 1. The filled cells form a triangle in the upper left. The empty lower right is not missing data. It is the future you are trying to estimate. Chain ladder fills it in, and the arithmetic is genuinely simple. For each pair of adjacent ages, you compute a development factor, sometimes called an age-to-age factor or a link ratio. It is cumulative redemption at the next age divided by cumulative redemption at this age. Compute it for every cohort old enough to have both numbers, average across them, and you have a single factor for how much redemption typically grows between those 2 ages. Then you chain the factors together, which is where the method gets its name. A young cohort with 3 months of history gets multiplied by the factor from month 3 to month 4, then 4 to 5, and onward until you reach the age at which redemption has effectively stopped. That final number is the cohort's ultimate. 2 things fall out of a triangle that no aggregate number can ever show you. The first is redemption speed, measured at the same age. If your 2023 cohort had redeemed 4% of its miles by month 3, and your 2025 cohort has redeemed 8% by month 3, then redemption is accelerating. And because that comparison is struck at a fixed age, it is immune to the growth distortion that ruins every aggregate metric. This is the leading indicator for the whole liability, and it is available right now on 2 years of existing data with no new instrumentation. The second is the demolition of the aggregate rate, the formal version of the warning from Chapter 1. Aimex's 10% cumulative redemption is low mostly because the portfolio is young, not because members do not redeem. Only the triangle, which holds measurement age fixed, can separate a young portfolio from a genuinely low-redeeming one. Everything else confuses the two, always in the flattering direction. Now the known weaknesses, because a method taught without its failure modes is a trap. Chain ladder assumes all cohorts develop alike. Devaluations, new partners and promotions break that assumption directly. 3 corrections apply. First, add a calendar period adjustment. This matters more here than almost anywhere in insurance. A devaluation hits every cohort in the same month, not at the same age. It lands on a 2-year-old cohort and a 2-month-old cohort simultaneously at very different points in their development curves. For a program with 3 value cuts in 12 months, ignoring that would corrupt every factor in the grid. Second, use Bornhueter-Ferguson for immature cohorts. This method blends the chain ladder projection with an a priori expected ultimate, weighting the prior heavily wherever little development has emerged. Third, cap or smooth the link ratios, so that one large early redemption in a very young cohort does not get multiplied by an enormous factor. Born-Hewitter-Ferguson deserves its own emphasis because it is the correct default method for a program that is 2 or 3 years old. Its formula is actual redemption to date plus the a priori ultimate multiplied by the percentage of development still unemerged. What makes it right is that it degrades gracefully. It behaves like chain ladder when you have data and like your prior when you do not, moving between the two with no discontinuity. It is also a method auditors already recognize, which matters when someone has to sign the number. Which raises the question of where the prior comes from, the most consequential judgment in the entire model. The comparables ladder runs like this. American Express at 96%, the ceiling case for a currency with no expiry, free transferability, and an always available cash equivalent redemption. United States Airlines, with disclosed breakage of 16 to 24%, implying ultimate redemption rates of roughly 76 to 84. McKinsey's industry-wide estimate of 15 to 30% expiry. Retail and coalition programs, far lower. And Qantas's disclosed flow ratio, 222 billion points earned against 185 billion redeemed in fiscal 2025, a ratio of 83%. Amex structural features push it toward the American Express end of that ladder. Fly Anywhere removes the award availability friction that causes most airline breakage. Gift cards clear small balances. The member base is self-selected. Pushing the other way is one feature. Small average balances against a 1,000-mile transfer minimum, which is the classic orphan balance reservoir. Net of both, the defensible band is 75 to 90%, with a central prior of 82 to 85. And then the discipline that makes a short history estimate credible: state the prior, state its source, state its weight, and backtest every quarter. Here the difference. 75% source, management judgment is indefensible. Whereas, posterior mean 83%, credible interval 76 to 89, prior anchored on disclosed airline breakage and adjusted upward for always available cash equivalent redemption, updated quarterly, backtest error within 3 points for 6 consecutive quarters. That second one is a model an auditor signs and an investor tests. Chapter 11, Curves, States, and Simulation. 3 more methods complete the toolkit. The triangle gives you the aggregate shape of redemption. These 3 give you the member behind it, the timing of the cash, and the shape of the tail. Start with survival analysis. It is the member-level complement to the aggregate triangle, and it exists precisely to solve the problem a young program has. That problem has a name: censoring. Here is what censoring means in plain terms. A mile issued 3 months ago and not yet redeemed is not evidence of non-redemption. It is what a statistician calls a right-censored observation. We know its redemption time exceeds 3 months and nothing more. It may be redeemed next week. It may be redeemed in 4 years. It may never be redeemed at all. The observation is incomplete, not negative. Now consider what happens if you ignore that. Computing redeemed divided by issued treats every censored observation as a failure. Every mile that simply has not had time yet gets counted as a mile that never will be. That single arithmetic shortcut systematically understates redemption, and it understates it worst where the number matters most, in a fast-growing program whose portfolio is mostly young. Kaplan-Meier estimation exists to use those incomplete observations without biasing the result. That is the entire purpose of the method. You compute 2 things. The first is the survival function, which is the share of points still unredeemed at each age. Its complement, 1 minus survival, is the cumulative redemption curve, the thing the triangle was approximating all along. The second is the hazard rate, which is the instantaneous probability of redemption given survival up to that point. Think of the hazard as redemption pressure at each moment in a mile's life. For a loyalty program, the hazard has a characteristic shape, and that shape is not monotonic. It starts near zero because you cannot redeem below the minimum. It rises to a hump as balances cross thresholds and redemption becomes possible. Then it decays into a long tail. And here is the single most important sentence in this chapter. A hazard that falls to zero, while survival is still well above zero, is the mathematical signature of breakage. In plain language, if the redemption pressure has gone to nothing, but a large share of the points are still sitting there unredeemed, you are not looking at slow members. You are looking at a subpopulation that will never experience the event at all. The formally correct way to model that is a cure model, sometimes called a mixture model, which estimates the never-redeem fraction as an explicit parameter rather than leaving an analyst to eyeball an asymptote off a chart. Breakage stops being a judgment call and becomes a number the model produces, with an uncertainty attached. 3 mechanics specific to Amex shape that curve, and each one has to be modeled explicitly rather than fitted around. The first is the 90-day maturation period. It makes the hazard structurally zero for the first quarter of every affiliate earned miles life. A curve fitted without accounting for it misreads a contractual lockout as low propensity to redeem. The members were not uninterested. They were not permitted. The second is the 1,000-mile transfer minimum, which creates a genuinely bimodal population. Some balances sit above the threshold and can act. Some sit below and cannot. Fitting one smooth curve across both is fitting one curve to 2 different animals. The third is the 12-month inactivity forfeiture, and this one is a competing risk in the technical sense of that term. A balance can exit the book in 2 different ways. It can be redeemed or it can be forfeited. Treating forfeiture as ordinary censoring overstates redemption, because censoring quietly assumes the member could still redeem later, and in this case, they demonstrably cannot. The correct treatment is competing risks with cumulative incidence functions. And here is the convenient part. That treatment produces exactly the 2 numbers finance needs, side by side, from one estimation: expected redemption percentage and expected breakage percentage. The second method is the Markov state model. It stops modeling points and starts modeling members. You classify every member every month into a state: new, active earner, active redeemer, accumulator, dormant, lapsed, forfeited. You estimate the transition probabilities between those states from 12 months of monthly snapshots, and then you run the chain forward. The output the triangle simply cannot give you is timing. Not how much cash eventually leaves, but when it leaves. That is the liability's duration, and duration is what turns a balance sheet number into a cash flow question. The state model also produces the finding that reframes Amex's whole strategy. The accumulator is the member who is earning, whose balance is rising, and who has never redeemed. That state is where a young, fast-growing program keeps most of its liability. It is also the state most easily mistaken for breakage. An accumulator looks exactly like a non-redeemer in a naive model. They are not a non-redeemer. They simply have not yet crossed the threshold at which redemption becomes possible. Now set that beside 2 facts already on the table. The dossier estimates that a median user needs somewhere between 3 and 9 years of organic earning to fund a meaningful flight. And Amex First exists explicitly to compress the time to first redemption. Follow the logic. A company whose product strategy is to shorten time to first redemption is a company deliberately converting accumulators into redeemers, which is to say, it is a company deliberately raising its own ultimate redemption rate. The liability should be modeled as rising with product success, not falling with it. The third method is Monte Carlo, and it closes the kit by replacing point estimates with distributions. You randomize 4 things: the ultimate redemption rate, drawn from its posterior distribution rather than fixed at a single number, the redemption channel mix, the cost within each channel, and the development timing. And you model them as correlated, because that is the part naive models get wrong. A devaluation, a redemption rush, and a cost spike are not three independent events. They are one event seen from three angles. Simulating them independently badly understates the tail, which is precisely the region you built the simulation to see. The scenarios that matter are these: a redemption rush that pulls months of volume into a single week, concentrated at the highest cost channel. Convergence of the entire book to the 1.8 cent floor. Drift of the redemption rate toward the comparables. A partner cost shock. And a growth shock, which belongs in the simulation as a policy variable rather than as a forecast, because issuance is a decision the company makes, not whether that happens to it. The output that justifies the whole exercise is a single chart. The simulated liability distribution, plotted against the cash balance. It answers a question no point estimate can answer. In what fraction of simulated futures does a 12-month redemption cost exceed available cash? That is not an accounting question. It is a solvency question, and it comes with a probability attached. Chapter 12, the Segmentation Imperative. One more principle before the blueprint, and it is the principle that separates a model from a spreadsheet. A single blended redemption rate is not a simplification. It is an error with a delayed fuse. The strongest evidence for that claim is simply that the largest issuer in the world refuses to use one. American Express segments its estimate by card product type, by enrollment tenure, by spend levels, and by credit attributes. United models, in its own words, the probability that an account will redeem its current miles balance, which is an account-level construction by definition. Southwest names its engagement predictors, so consider what follows. If a blended rate were adequate, the most sophisticated points issuers on Earth would not be running segmented models, and their auditors would not be treating the resulting estimates as critical audit matters. The mechanism, stated plainly, is this: breakage is not a property of a point. It is a property of the member holding it and of how they came to hold it. Think about the three ways a point can arrive. Points a member deliberately worked for, where they routed a purchase through the app, linked a card, chose the higher earning path, arrive already carrying revealed intent to accumulate. That member has told you something about their future behavior through their present behavior. Points that arrived as a windfall, a promotion, a referral bonus, a sign-up credit, carry no such intent, and a great many of them land in accounts that were opened for the bonus and then never used again. And points pushed by a third party, whether business-to-business issued or handed out as employer perks, are held by members who never opted into the currency at all. Same point, same balance sheet line, three completely different probabilities of ever being redeemed. Applied to the actual channels Amex operates, three consequences follow. Each of these is labeled as analysis rather than as finding, because no comparable program publishes channel-level data against which to check them. Consequence 1. The referral channel is the clearest case for segmentation anywhere in the book. The two-sided referral bonus runs somewhere between 700 and 1,000 miles, which places it below the 1,000-mile transfer minimum by construction. The recipient cannot transfer that balance without going out and earning more. And if they never earn more, the balance is dead. It is also, precisely because it belongs to a member who did nothing else, the balance most exposed to the inactivity clause. So applying a 75% redemption rate to referral miles almost certainly over-reserves them, and applying that same 75% to deliberate affiliate earning almost certainly under-reserves it. The blend hides both errors at once, and because they point in opposite directions, they offset. They keep offsetting right up until the mix changes. Consequence 2. Business-to-business issued miles must be a separate book entirely, not merely a segment within the main one. Here is why the distinction is not academic. For consumer-earned miles, Amex pays for fulfillment out of affiliate revenue that has already been booked. For business-to-business miles, a partner has prepaid roughly 1.4 cents against a cost of roughly 1.16 cents. That is not a loyalty liability in the ordinary sense. That is a sale with deferred delivery. Different economics, different accounting treatment, and critically, a low redemption rate in that book is margin rather than risk. Now recall the dossier's finding that the 2 billion mile issuance target is only coherent if the mix shifts hard toward prepaid business-to-business issuance, which means this single split is the difference between reading the entire growth plan as a revenue story and reading it as a solvency story. Those are not close to the same conclusion. Consequence 3, and this one is the silent killer, mix drift. Suppose the channel mix shifts toward high-intent affiliate earning and card-linked earning, which is precisely what closing the share-of-wallet gap means in the strategy. The blended redemption rate then rises mechanically, even if no individual channel's behavior changes at all. Nothing about any member has changed. Only the weights have changed. And so a company can execute its stated strategy perfectly and watch its liability per issued mile increase as a direct result. Sit with the consequence of that for a moment. Only a segmented model can distinguish between two explanations that look identical in the blended number. Explanation 1, our members became more engaged, which is good news and also expensive. Explanation 2, our estimate was wrong, which is bad news and also expensive. Without segmentation, management literally cannot tell a success from a modeling failure inside its own accounts. It sees one number move and has no way to attribute the movement. And segmentation applies twice over, because the cost side of the equation varies just as much as the redemption side does. Gift cards clear at under a cent. In-app bookings run around a cent. Transfers to airline partners land between 1 1/4 and 1 6/10 of a cent. And Fly Anywhere costs 1.8 cents in hard cash. The blended figure of 1.5 cents is therefore a weighted average across a distribution that management only partially controls. And as established back in Chapter 1, the weights in that distribution drift toward the expensive end as members become more sophisticated, which means the blended cost per mile is not a constant to be plugged into a model. It is a moving quantity with a direction of travel, and the direction is upward. Put the two blends together and the problem compounds. A blended redemption rate that drifts up with mix, multiplied by a blended cost per mile that drifts up with member sophistication. Two averages, each concealing its own internal movement, multiplied together to produce the most important number in the business. That is the segmentation imperative. Not that segmentation produces a more precise answer, though it does. The point is that segmentation is the only thing that lets you know why the answer changed. A blended model can tell you that your liability went up. Only a segmented model can tell you whether that is because your product worked or because your assumption failed. And those two diagnoses call for opposite responses from management. So the blend is not a shortcut you take today and refine later. It is a decision to remain unable to diagnose your own most expensive line item, made at exactly the stage of company life when the mix is changing fastest. Chapter 13, the blueprint. Here is the specification. 6 inputs, 6 methods, 6 outputs, and 4 cadences. All of it sized for a 30-person company with no actuary on staff, using data the company already generates. Start with the inputs. None require new instrumentation. All of this is already being written to a database somewhere in the business. Input 1 is a member-level issuance ledger. For every earning event, you need the member identifier, the earn timestamp, and separately the maturity timestamp, because those are different moments. Then the number of points, the earn channel, the merchant or partner identifier, a promotion flag, the funding source, and the market. Input 2 is a member-level redemption ledger. Member identifier, timestamp, points, redemption channel, partner, transfer ratio, and then the one that matters most, the actual cash cost of that redemption. The cost per point has to be measured, not assumed. American Express derives its weighted average cost from 12 months of actual redemptions, and so should everybody else. Input 3 is a forfeiture ledger, with the reason for each forfeiture recorded. Without reasons, competing risks cannot be separated, and the survival model cannot be built. Input 4 is a monthly engagement panel. logins, sessions, card links, merchant clicks, transfer partner page views, support tickets, and referral origin. Input 5 is the external priors drawn from the comparables ladder. And input 6 is the policy parameters, which deserve a moment of emphasis because they are decision variables rather than forecasts. The floor rate, the transfer minimum, the maturation period, the enforcement stance on inactivity, the partner cost schedule, and planned issuance. Every one of those is something the company chooses, which means every one of them is a lever the model can be run against before the choice is made. One decision inside the data layer is not a technicality. When a member redeems which cohort's miles were spent, first in, first out is the audit defensible convention, and it also matches how members perceive their own balances. But what matters more than the choice itself is that the choice is documented, applied consistently, and disclosed. A program that changes its conventions midstream has destroyed its own triangle. Now the methods, in the order a program should adopt them. First, cohort triangles built per earn channel book with the calendar period adjustment applied. Second, survival analysis with censoring, competing risks, and a cure model for the breakage fraction. Third, the ultimate redemption rate estimated via Bornhueter-Ferguson with Bayesian priors, 1 per book. Fourth, a Markov member state model for timing and duration. Fifth, a machine learning challenger model for feature attribution, and note the word challenger. The classical curve remains the booked estimate because it has to be explainable to an auditor. And sixth, Monte Carlo with correlated draws. Then the books, 5 books not 10 channels, collapsed on day 1. Book 1 is deliberate earn, meaning affiliate shopping and in-app voucher purchases, with a prior around 88%. Book 2 is card-linked and passive earn, meaning card maximizer, issuer partnerships, and transit, with a prior around 82%. Book 3 is coalition inbound, meaning U and Octopus, at around 85% and modeled separately for speed as well, because currency switchers may convert and then immediately redeem. Book 4 is bonus and windfall, meaning referrals, campaigns, and employee benefits, at around 45%, with a wide band running from 30 to 60. And Book 5 is business-to-business prepaid, held as a separate book entirely. Blend that machinery back together, and it produces something in the region of 80 to 85%. The working assumption it replaces is 75. Now the outputs, 6 deliverables in the form a board and an auditor both accept. 1. Expected fulfillment cost, total and per book, presented with a credible interval rather than as a point estimate. 2. Blended and per book redemption rates with the priors, the weights, and the posteriors all stated openly. 3. Liability duration and the redemption cash flow profile, months 1 through 36, plotted against the cash balance. 4. A sensitivity table in the American Express format, plus or minus 1 point of redemption rate, plus or minus 0.05 of a cent of cost, full convergence to the floor, convergence to the comparables. 5. A redemption velocity chart showing cumulative redemption at fixed cohort ages of 6, 12, and 18 months, cohort over cohort, by book. And 6. The backtest record, projected versus actual, across 4 rolling quarters, with the error expressed in percentage points. That last one deserves its own sentence. The backtest record is the single most persuasive artifact a young program can produce. It converts the statement we assumed 83% into the statement our assumptions have been accurate within 3 points for 6 consecutive quarters. Those are different species of claim. No amount of model sophistication substitutes for a backtest record, and it cannot be manufactured retroactively, which is the entire argument for starting now, rather than starting when the auditor arrives. Now the cadence, 4 of them. Monthly. Refresh the triangles, reconcile modeled points outstanding against the production ledger to the unit, update the velocity chart, and flag variances. Quarterly and owned by the Chief Financial Officer personally. Re-estimate the posteriors, backtest and record the error, rerun the simulation, refresh the sensitivities, and produce the board page. Annually, methodology review, prior rederivation, independent review, and the voluntary public disclosure. And fourth, event-driven and mandatory. Run the model before announcing any devaluation, any partner change, or any major promotion. That last cadence rule is the one that changes the company. It inverts the current order of operations, and in doing so, it converts the model from a reporting tool into a pricing tool. Who builds it? One analyst actuary hire, which is the missing risk hire the dossier already identifies as the most striking gap in the organization, plus a periodic independent review from the one specialist firm that exists in this niche. A firm that explicitly sells the exhibits an auditor needs to sign off on a loyalty liability. The total cost is one salary and a review engagement. Set that against an estimate that represents 56% of all the capital the company has ever raised, and which sits as the highest scored risk in the company's own risk register. Finally, 2 disclosure moves that cost nothing at all. The first is to publish the pair. Cantas discloses points earned and points redeemed, which lets any outsider compute a flow ratio and sanity check the assumption without ever seeing the model. Amex published that pair exactly once. 272 million earned, 27 million redeemed, and then stopped. Publishing once and stopping is worse than never publishing at all, because the last public number is the flattering one, taken from the youngest version of the portfolio. The second is to publish the assumption American Express style. The rate, the method, and one sensitivity. No private company is obliged to do any of this, which is precisely why doing it registers as a credibility asset rather than as a compliance cost. And the dossier's own watchlist already lists voluntary liability disclosure as a positive signal. Chapter 14, The Verdict. 4 conclusions, a 90-day list, and the falsifiers. Conclusion 1. The liability is probably larger than the company's working number, and the error is structural rather than careless. 75% is an airline prior. It was formed in an industry where breakage is manufactured by award seat scarcity, and it is being applied here to a product deliberately engineered to remove exactly that friction. The band this study supports is 75 to 90%, centered somewhere around 82 to 85. The difference between that center and the working assumption is roughly $800,000 on the current book, and it grows with every mile issued. Nothing in that finding suggests bad faith. It suggests an unvalidated assumption inherited before there was any data to test it against, which is exactly the situation every young program is in. The problem is not that the assumption was made. The problem is that there is now enough data to replace it, and it has not been replaced. Conclusion 2. The 2 terms are correlated, and the correlation is the real risk. The redemption rate and the cost per redeemed mile both rise as the product succeeds. They rise for the same underlying reason. Success means members crossing thresholds, discovering the floor, and then redeeming rationally at 1.8 cents. A model that treats those 2 terms as independent will understate the tale, because the bad draws on each term arrive together rather than separately. And the stress case here is not exotic or hypothetical. It is the convergence case, and the arrow of time points directly at it. Conclusion 3. The run exposure is roughly the size of the balance sheet, and nobody is watching it. 700 million miles valued at the floor rate is about $9.5 million of gross claim, standing against roughly $9.5 million of cash. That ratio is survivable and entirely unremarkable in calm conditions. It is also exactly the ratio that no dashboard in the company currently tracks. And this is a company that has already experienced one internal redemption surge severe enough to force an 8-day devaluation. The surge happened. The metric that would have anticipated it still does not exist. Conclusion 4, and this is the reframe that matters most commercially. The liability model is not defensive, it is part of the multiple. The dossier argues that shifting the narrative from rewards apt to the redemption network for Asia's loyalty economy is worth somewhere between $80 and $120 million of valuation. But infrastructure is priced on predictability. That is what the word means to an investor. And a currency issuer that cannot quantify its own float does not get valued as infrastructure, no matter how the pitch deck is worded. At Series B, the model stops being a risk artifact and becomes a valuation instrument. Now the 90-day list, 8 items, all achievable inside a quarter. Assemble the event ledgers and reconcile them to the production system. Build 5 cohort triangles by book and publish the velocity chart internally. Fit survival curves with competing risks and produce a first posterior redemption rate per book with the priors stated. Compute the run exposure ratio and put it on the monthly dashboard. Write the methodology document before the first estimate is booked, not after. Make the pre-announcement model run a mandatory step in devaluation governance. Hire the analyst actuary. And decide, in writing, whether the inactivity clause is actually enforced, because the auditor will ask and the marketing has already answered. Which brings me to the last section, and the one I consider the most important in the study. What would prove this analysis wrong? If Amex own cohort triangles, once they are built, show redemption asymptoting below 75% at fixed ages across the 2 oldest cohorts, then the airline prior was right all along, and this study's central estimate was too high. That is checkable within 1 quarter of building the model. And it is, honestly, the single most valuable thing the model could tell you, because it would mean the company is over-reserving against a risk that is not there. If the channel-level curves show no material spread between the deliberate earn book and the bonus earn book, then the segmentation imperative is overstated, and a blended rate is defensible after all. If the redemption velocity trend is flat or declining cohort over cohort, even while the product ships improvements to time to first redemption, then the accumulator thesis is wrong and liability will not rise with product success. And if the floor convergence never materializes, if members keep taking gift cards at a cent when 1.8 cents is sitting there available to them, then the correlation thesis is wrong and the 2 terms really can be modeled independently. Notice what those 4 falsifiers have in common. Every one of them is testable with data Amex already has inside a single quarter at the cost of 1 hire. None of them requires new instrumentation, a consultant engagement, or a rebuild of the data platform. They require somebody to sit down and do the work. Which is, in the end, the whole argument of this study, so let me state it once more as plainly as I can. The most expensive number in the business is currently an assumption. The machinery to replace that assumption with an estimate is well documented, sitting in public filings, and about 40 years old. And the company is 1 analyst and 1 quarter away from actually knowing. Everything in between, the triangles, the survival curves, the state models, the simulation, the segmentation, the cadence, is just the detail of how you get from the assumption to the estimate. The industry built all of it in public. The airlines disclose their breakage. American Express discloses its rate to the basis point. United's auditor named the technique. Southwest named the predictor variables. Qantas publishes the pair of numbers that lets an outsider check the whole thing. None of this is proprietary. None of it is hard to find. It is simply unassembled, and the cost of leaving it unassembled falls hardest on precisely the companies that are growing fastest, because those are the companies whose portfolios are youngest and whose assumptions are therefore least tested. A points currency is a promise with a price. The price is knowable. It just has to be measured. This has been an independent analysis based entirely on public sources, current as of August 2026. Estimates are labeled as estimates, and nothing in it is financial advice. Thank you for listening.